get some analysis on this with Mark Todd, who joins us now from FIIG Securities. Just to review the decision with you, Mark, and I know you were part of the coverage yesterday, but reflecting on, I guess, the statement and all the commentary around today, do you think it was a tough call for Governor Stevens to make such a big cut?
I think the thing with Governor Stevens was that there's been a lot of criticism about the RBA being reactive over time, and through the GFC they were quite proactive, and I think the Governor Stevens can see the movement in what the banks are doing, and he'd probably like to try and reclaim the high ground. And so if they become proactive in terms of their interpretation of the economy, I think they see that as beneficial to the RBA in its general behaviour.
You know, this was a very politicised decision, wasn't it? Because there was pressure from all sides to give a bigger than normal cut. It delivered that. Is there any questions? Would you think there's questions about its independence?
No, I don't think so. I think there's naturally pressure. I think the situation in the economy starts to become exacerbated as it gets softer, and the numbers were becoming weaker quicker. In terms of their interpretation of those numbers, they were getting some data very quickly showing that inflation had been mitigated in a meaningful manner. So it makes sense that they're going to be proactive. I think they like to be able to exclaim their independence on a regular basis. So if everyone was going, we've often spoken about the financial markets looking to run forward with interest rate movements, they're looking to buy the interest rates, and the governor looks to not do anything, so the markets get hurt. I think they quite like that opportunity.
Mark, the November and December rate cuts, they didn't really have much of an impact. I guess we could say that.
That's true. Do
we expect that this one will, make any more of a difference than the last two?
I think everyone who is surprised about it's around the expectations. The expectations truly were for 25 basis points, and so to double it, to do 50 basis points, that's generated a conversation at the very least. So it wouldn't necessarily mean that $20 a week is a meaningful change into everyone's pockets, and it will be for some. It's more about the expectations on future rate cuts and the jawboning effect of the government of the RBA. And the RBA has certainly left the door open that it might go further. It will stimulate a conversation amongst most borrowers with this is an opportunity to start looking at some assets and try to buy them.
Well, this is a question as well of when it comes to asset allocation or where people want to put their money. If rates are being cut, is cash still king?
You should always put your money in bonds, Brooke. You know that.
Those term deposits.
The reality
is, isn't it? Because people in the equity market have often argued about the cash on the sidelines, and when that's deployed, that can be very powerful. If we start to see deposit rates coming down, what are you expecting on that front? How much will they come down? Because then you do start to wonder when that tipping point is, where people say, enough of the term deposits, they've been great, but now's the time to put money back into equities.
I think the problem for the equity market has been that the story is the same. This is always a great time to put money in the equity market, and we know that. That's a constant refrain because they want you to be in their equity markets. In a balanced portfolio, you need to be in cash, you need to be in bonds, and you need to be in equity. That's fine. It's just, is it 70% equity? It's unclear to me why you'd want to be 70% in equity with all that volatility. The reality is the banks will still want to try and win as much of your money as humanly possible, either in the form of bond issuance, in the form of hybrid issuance, or in the form of term deposits. And they need to take some of the heat out of that European investor base where they get money, and they will still make term deposits attractive. So if we think about mortgages not going down the full 50 basis points, we also need to think that term deposits won't go down the full 50 basis point.
Yeah.
And so we'll see, and we are seeing today, some of the regional banks are offering some really attractive rates in term deposits. The key for the investor is the longevity. Do I invest at government yields for 1 year or 2 years in the form of a term deposit? It makes sense to do some of that. It makes sense. We don't know what the investment climate will be in the foreseeable future when we look at Europe and North America, and the governor saying I've dropped it by 50 basis points because I'm worried about these different sectors. That doesn't mean I should go and buy equities. It just means I should be balanced. I should be cautious like the government is. And
is there enough bonds to meet the demand that you're talking about?
Clearly there's enough bonds around at the moment, and I think the four banks drive a lot of the issuance. I think corporate Australia will look to drive some of that issuance as well. But the 4 banks will look to try and take advantage of any lower rates to issue into that market. They did the hybrids and they did billions in the form of hybrids. I think they'll be waiting on the wings to see what the appetite's like for more investors, and they'll issue into it.
Mark, Todd, thank you so much. Great to have you on board today. Thanks.
Bye.
From FIIG Securities, Director of Institutional Relations.